Hi guys, here's Hustle Hub. Today we're going to talk about CDS. But before we get started, remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. So let's get started. A credit default swap, or CDS, is a financial derivative that allows the holder of swapping the credit risk over a certain credit financial instrument with the counterpart they dealt the CDS with. For example, if you fear that a certain bond or any credit financial risk might not be able to back what it owes in the future, you might buy a credit default swap in order to unload the risk on a counterpart. Given that many debt financial instruments have a very long lifetime, even 30 or 50 years, and it is hard to understand the underlying risk that the asset will face during this long time. So credit default swaps are a great instrument in order to manage this risk over the long term. In order to have this instrument, you will have to pay an upfront fee and reoccurring payments during the whole duration of the contract. On the other side, and the seller of the CDS agrees that, in case the debt issuer of the financial instrument fails to fulfill its obligations of paying back the full value of the instrument plus the interests, the CDS seller will make up for that to the buyer. When we think about these instruments, they are not that different from insurance as a general concept. The buyer of the CDS is safe that he will be paid what he is owed by paying an upfront and then recurring fees. On the other side, the seller guarantees the credit worthiness of the fixed income security. Of course, the sellers need to accurately manage their risks, something that didn't happen in the 2007 and 2008 crisis. Companies like Bear Stearns, Lehman Brothers and AIG failed to manage the risks involved with these swaps and lost an incredible amount of money. If you're watching this video, there is a good chance that you are here because you watched the Big Short movie. The managers in the movie were speculators, and they made a bet that the price of the credit default swaps were going to appreciate as a result of the defaults that would happen in the mortgage bonds. Baum and Burry bought CDSs on lower-rated mortgage bonds, which had a lower payout given the fact that the underlying mortgage bonds were already starting to crumble. The guys at Brownfield got the highest payout because they bought CDS on higher-rated bonds that were thought incredibly unlikely to default. Well, thank you guys for watching the video, and remember to give us all your support by subscribing to the channel, smashing the like button and turning on the notification bell. See you next time with another video for you. This is Hustle Hub.